This is Money Matters with Dean Greenberg, the founder of the Greenberg Financial Group. I'm Spike Spangle. Dean, you and I talk a lot about market volatility. And if we look in the rearview mirror of last year, both the stock market and the bond market were correlated for one of the first times in over 40 years. And when I say correlated, I don't mean in a good way.
Every time we have a market drop, there's always something different. Well, this one was all about stocks and bonds dropping. You got blasted. And it's because the person managing your money didn't look at and say, you know what, interest rates are going to go up, so your bonds are going to go down. And most people use what? ETFs. We were in long-term ETFs. I shortened that to short-term ETFs way before they started raising rates, 1 to 2 years. Then when they started raising the rates, we went right down to 1 and 2 and 3 year bonds. And we start laddering them, so as they come due, we get higher rates. That saved us at least 10%.
Now, what about the market volatility of the stock market? There wasn't much you could control there, or was there?
You got to manage the money. And there's 2 ways to do it. People just farm it out, and they have responsibilities to keep invested. Or they use all the ETFs, and they just stay invested, and they reallocate. Personally, I can't do that. I've been around too long. It's one thing when you're 40 and you sit through it, than when you're 65 and you just retired. So mitigating risk is very important. The way we mitigate risk is we reduce our positions and we raise cash. We increase our bond exposure with short-term bonds. We hedge the accounts by buying puts in the account. And then the other thing we do is we buy the inverse funds. Simply, markets go down, this goes up in value. It's a hedge against your account. Most people's risk tolerance is about fear. So you have to understand that we're not dealing with institutions, we're dealing with individuals. Every time the markets go down, our conversation with them now is, we're hedged. We come down, we're going to lose a little bit, not that much, but we will lose a little bit, and then we're going to get aggressive to the upside. Think about history. Markets always come back. This market will be the same thing. You take your cash, you reduce your bond exposure, you go back into the other side, and you wait for things to happen. And then everyone wants to wait. The markets will come back. They're low on interest rates. Everything looks great. That's when they want to get in. I want to get in before them.